According to the Chinese zodiac, every year is associated with one of 12 zodiac animals. And 2021 is the year of the ox, the second animal in this 12-year rotation. In traditional Chinese culture, oxen are true representatives of strength, hard work, diligence, and calmness. However, this year has been anything but calm or strong when we talk about the Chinese stock markets. In this video, we will discuss some of the reasons why the Chinese stock markets have performed poorly and how do we position ourselves for the future.
Guys, a lot of work goes behind the scenes in making these videos, and your help can go a long way. May I ask that you hit the like and subscribe button so that you continue to benefit from our top quality research?
It all started at the end of February, right after the year of the ox commenced. The Chinese stocks continue to lag the global stock markets and are currently underperforming the US stock markets by over 15%. How did it start? On 27 January 2021, the PBOC injected 180 billion Chinese yuan of liquidity via its usual 7-day open market operation. However, with 280 billion of central bank repo maturing, this was equivalent to a 100 billion withdrawal, starting a taper tantrum as we know it in the markets. This capped a 6-day period of liquidity withdrawals totaling 568 billion yuan. Market-driven repo rates, which were already edging higher ahead of the Chinese New Year holiday, spiked upwards to multi-year highs, while investors contemplated the spectacle of a more hawkish PBOC and significant tighter liquidity conditions. The PBOC has withdrawn a significant amount of liquidity since the start of January, which is in sharp contrast with previous years, when the central bank typically increased liquidity in anticipation of higher demand ahead of the Chinese New Year holiday. A hawkish PBOC pivot would be in direct contrast to the Federal Reserve's monetary policy stance as well, and potentially stifle the recent rally in Chinese asset prices. Then, we saw China's regulatory push throwing a wrench in the stock market's comeback plans. Seriously, the headlines make for some very painful viewing if you were a Chinese stock investor. The index plummeted by more than 45% since hitting a record high in February, which led to a $770 billion wipeout in the value of the US-listed Chinese stocks. This regulation push started at the end of last year after China's highest-profile entrepreneur, the brains behind Alibaba, Jack Ma, said this at the Financial Forum in Shanghai.
好的创新不怕监管 但是怕昨天的方式去监管
The fallout from the Alibaba episode was immense, not only for the company, but for other Chinese conglomerates as well. We saw Beijing tighten its net from tech to education, and the Chinese stocks were Asia's worst performing as the Beijing crackdown spooked the investors. We discussed the pressure from the Chinese regulators, and now it's the US regulators' turn to add to the uncertainty. But first, let's find out what American Depository Receipts or ADRs and Variable Interest Entities or VIEs are. Well, ADRs and VIEs are a very convenient way for US investors to hold US-denominated Chinese equities. The US investors can avoid foreign currency risk and capital controls. For Chinese issuers, an important benefit is the ease of listing in the US, as this approach bypasses several requirements compared to listing in Hong Kong or mainland China. Speaking of the US ADRs, there are over 250 Chinese ADRs with the combined market cap of over $1.5 trillion, with some well-established names like Baba, JD, Pinduoduo at the top of the list. Now, there was increased pressure from US regulators regarding reporting requirements for ADRs, and this could lead to forced delistings due to consistent non-compliance. The investors are in the middle of it all, not sure if their investments in these ADRs or VIEs would be worth anything. It seems like a case of saving the worst for the last, but we have the Evergrande Saga at the end. After expanding rapidly for years and snapping up assets as China's economy boomed, Evergrande is now snowed under a crushing debt of $300 billion. This Chinese developer is so huge that the fallout from a potential failure could hurt not only the Chinese economy, but there's also a risk of contagion. This Chinese property developer announced on the 14th of September that it has engaged financial advisors to explore solutions to ease its liquidity issues. This triggered fears that the company's liquidity issues present a systematic risk to the country's financial market, given the property sector's direct credit exposure via bank and trust loans. Sectors where we have already started to see impact include property, banks, upstream materials, and downstream consumer durables. Looking towards the future, firstly, it can be easy to forget that there is a bearish market nearly every year in the Chinese stocks, with significant drawdowns, and 17 of the past 20 years have been a testament to that. These drawdowns are usually driven by some policy issue. Historically, investors have tended to be compensated for this heightened volatility with strong annualized total returns. From August 2001 to August 2021, the MSCI China Index produced an annualized total return of over 12%, outperforming the 9% produced by the S&P 500. Timing any market is difficult, and China can be even more challenging. There is a risk that the regulatory rollout may continue, property prices could fall, and undermine consumer confidence, not to mention the potential for COVID-19 related concerns and the tense US-China relationship to weigh on the growth outlook. You need to ride the tailwinds and avoid the headwinds. There are some areas where the government is cracking down. However, there are other areas where the government is attempting to restructure economy. For example, the semiconductors, the green tech, and the consumer brands. Be particularly selective with e-commerce and online video game companies. And it's too early to fish for hardest hit names right now as there is a lot of uncertainty. Finally, follow MoneyWiseSmart. We cover a number of Chinese companies such as JD.com. We can help you maneuver through the challenges of investing in China. Remember, it's the second biggest stock market in the world, so you cannot afford to get it wrong.
If you found this video useful, then I urge you to join our research platform. It's completely free, there are no hidden costs, and that's the place where we publish top quality research covering companies with the capability to compound in the long term. And that's also the place where we publish research discussing key investment concepts. So if you would like to increase your knowledge of investing, then you would surely benefit from joining that platform. The link is in the description section below. Guys, if you found this video useful, then don't forget to hit the like and subscribe button.